Hi everyone, and welcome to today's Q&A on the 10th of March. So welcome everybody probably joining in from Tom's live stream earlier on. It seems it's a lot when you're going from one to the other, isn't it? But we'll get into some of the charts. I know we're going to look at some different things here. We certainly saw some big moves last night. Can I just have confirmation that everyone can hear me okay?
Sure can, Ty.
Great.
Can
All
hear
right.
you.
Awesome. Everyone all right? Yeah, so we saw after the webinar last night, I'm not sure if you guys caught it or not, but we were talking about those those very key levels actually on oil and on gold, and then we saw a massive sell-off on those. And it's not even a sell-off. I mean, it was just an absolute it was a capitulation really. Again, and this is what we were talking about last night. I mean, it's obvious that it was going to happen, but we just don't know when, and that's the problem. Like, it's not like, and that's what makes it hard to trade. Like, it's obviously unsustainable that oil considered $131 a barrel US. But there was nothing actually stopping it going to 140 or 150 before it actually fell. And there's no way that you could actually time this without taking risk, and that's what we were trying to talk about. That's not, if you go to the smaller time frames on that, it's very, very difficult to try and get into that. Like, there's no pullbacks even to the 20 moving average. It was just a big consistent sell-off. So did anyone, just out of curiosity, did anyone actually long or short or anything? Oh, no screen, hang on.
I took a put spread.
You did? Hang on, just let me bring the screen up. Sorry, I didn't have the screen up. I've just gone to oil now. Can everyone see the screen now okay?
Yeah,
Yep.
I'm seeing you.
Yeah,
now.
we
Awesome. Awesome. Yeah, so I mean, like you said, it's a big, massive sustained sell-off, and like you can see even here on the 4 hour, it's just candle after candle. And even if the problem is, right, like even if you came in here and said, okay, that's two negative candles in a row, and it could potentially keep falling, there's still no guarantees that it couldn't have reversed from there. That's the problem. That to me is just very, very messy trading, and that's not really trading for mine. That's just more speculating. And if you can do it and you do okay, that's all right. But in reality though, you're not going to make your bread and butter every day on those sorts of trades. So that's why for me, I would probably prefer to stick clear of them, because I just find it easier to stick to the stuff that I know works, and I know that I can rely on consistently. Did someone say they had a spread on oil? Did I hear someone say they bought oil and spread it?
Yeah, I took a March 17th 101.5 to 101 for 4 cents.
Yep.
And
Okay.
that's looking good, but I don't know if that's going to play out or not.
Yeah, well, the thing with when the volatility is high, you can always look at potentially closing them out early if you need to. You might hit your profit quicker than you expect, and maybe you can take it out. Like, you don't always have to go to expiry.
Yeah, I wanted 25 cents and it gave me 20 and I missed it. Was doing work stuff, so that may get
Oh, okay,
closed tonight.
yeah. Don't you hate that?
Yeah,
No.
I should have
Yeah.
put it on after I put the order on and I didn't, so it is what it
Yeah.
is.
Yeah, but look, you know what, you had the right idea, and it's and the thing is, probably with these sorts of plays, if you are going to, I mean, we didn't really mention it last night at the webinar because we try to keep options out of the webinar a little bit because we talk about them everywhere else. But in reality, if you are going to trade something like gold or something like oil, you are better off actually using an option to do it, because then that is actually a safe trade. It's still a speculation as to whether it's going to go higher, whether it's going to go lower. But what you know for sure is you're not going to get caught up in the whitewash of big volatility. You're not going to get stopped out, obviously, because it can't happen with an option. So your worst case is your worst case. And still, I certainly, and when I say options, let me say that with a word of caution. I'm not talking about naked options or anything stupid like that. I'm talking about fixed risk options there, right? So if you're going to take a straddle either side, that's fine as long as it's a bought straddle. And if you're going to take anything like a spread or anything that's actually fixed risk, no problem, right? You got no worries there, because at the end of the day, whether it works out or not is irrelevant, because your worst case scenario, and that's the only thing that really matters, right? As long as you know your worst case scenario and nothing can mess with that, you're going to be okay most of the time. Nothing wrong with that. Okay. What I find problematic in trading these is, and this is, we couldn't, like I said, we didn't have enough time to talk about it last night, but the biggest problems with actually trading the CFD version or the futures version or whatever it is you're going to trade is that, quite often the whipsaws will take out a stop loss and then often go in the direction anyway, right? And if that happens, you're going to get the worst spread. You're going to get stop hunted, and to navigate that, if you know that that's potentially going to happen, right, what are you going to do? You're going to put your stop loss out further and further to give it more room, to breathe, right? And when you give the stop loss more room to breathe, you're going to have to reduce your contract size, because obviously, unless you're taking extra risk, which is the last thing you should be doing, and boom, all of a sudden, what the hell's the point of taking the trade? You have to give it a bigger stop loss to allow for the whipsaws. You have to reduce your contract size to allow for the bigger stop loss to keep it within your risk parameters. It negates what you're trying to achieve in the first place. But if you use options where you don't have to have a stop loss, okay, your stop loss is effectively your worst case scenario. So you just do, the spread or the fixed, or you could buy a put if you wanted to. You could do it. There's plenty of options that you can do that are completely fixed risk, but they're the ones that I would use in those situations, and there's nothing wrong with that. Okay, but the problem is what you're going to find is that if you were trying to buy, let's just say at $130, right? It's logical probably to think, well, I'm going to buy a put here because at the end of the day, it's going to fall eventually. It can't stay at these prices, and if my put's out far enough, what's going to happen is I'm going to make money. The problem is, though, that the further you put that put out, like let's just say you got ambitious and went to April or May, you might have to pay $20 or $30 for that put, right, at that price. Now, what does that mean for the trade? Well, it means that it has to be below $100 before you start making money. Okay, your worst case scenario is $30, sure, but if it's not below 100 at that point, you're not going to make any money. So that's a really, really big move. So that's not the ideal way to play it. My ideal way to play that is actually to put a spread above it. So that way, all it's got to do is move a little bit, because you can do the same risk. Like even if you're taking a $30 option, I mean, if you're only risking say $1,000 in your account, say you got $100,000 in your account, you're only risking $1,000. You either buy $1,000 worth of that particular put, or you take a spread. But the difference between the risk is the same. You're still only risking $1,000, but the difference is if the price is below 129.90 or 99 at the expiry, you're going to make money. You're going to make the full money, actually. So that to me is the sensible trade there. Okay. Now, if it was the other way and the volatility was out of the market, and this is where options are really cool, right? If there was no volatility in the market, obviously volatility at $130 was absolutely, the premiums were just ridiculous, right? Obviously ridiculous. But if they weren't ridiculous and it was a flat market that we were talking about where the volatility was low, very, very different story, because you might only end up paying $4 or $5 for that put, not 30, right? And with the spread, you're only going to get a 1-to-1 probably at best trade. So you're only going to make 1,000 on 1,000 that you're risking. But on the other one, where you actually buy the put, it's going to be maybe cost you $4 or $5, okay, which is about 4 or 5%, or a bit more at that height. But the magnitude of the move could be a 5 or 6 banger. Like if it went all the way down to 100, you're going to make $25 for your $5 risk. Okay, so that's where you have to weigh up whether it's actually worth it. It's really, really easy to do that when you actually it's hard to predict what the volatility is going to be into the future, but it's really easy to see when you are actually there. Lenny, you got a question, mate? Yeah, sure, fire away.
So thanks, Ty, for that. So usually with I know listening to the webinars, Tom will usually say that if there's a gap, particularly in stocks, it will get filled. So I'm just wondering, because I've seen, because of the volatility, there's been a few gaps opening up, particularly on currencies and the commodities. Is it the same principle that if there's a gap on the Euro USD, will it generally look to fill it, or will it just move in its own direction?
Yeah, quite often it can fill it, but I don't rely on that anywhere near as heavily as Thomas does as an indicator of what may or may not happen, because gaps happen for a reason, and sometimes it's a big magnitude move that doesn't actually come back. There's no guarantee that they're going to come back, and for mine, I don't really rely on them as much as Tom does, because I don't Well, I don't really need to, because to me, I'm sort of reading the price action, and I don't use that as a guide. Look, it's hard to put a stat on that whether the gap actually fills or not. For the most part, when you're looking for them, you see the gap and you see it fill, and you say, oh yeah, that's all cool. But sometimes the timing of that gap fill isn't as easy as it looks like in history, and that's the problem for mine. That when a gap first happens, say for instance, like you get a big volatile move right here. Like, let's look at this for a second, right? So you got oil, you see that big giant move, and all of a sudden, we're trading at 123 instead of 117, right? That's all good and well now that we've seen the gap fill, but this gap only just filled, through this part here. At this point here, I'm not looking in any way, shape, or form to try and short this market, because that's actually, going against what is very, very strong momentum. If I was going to use a gap, okay, I would be using that gap as a potential reload, which is a different story. Like, say, for instance, we've got the gap here. I wouldn't be seeing that gap expecting it to fill and saying, all right, I'm going to short that down to try and fill the gap. I would look at this and say, if I've missed this initial trade, which is probably generally what happens when you've seen a gap, I will wait for that gap to actually get back to the level where it broke in the first place, and then I would look at taking part if there's still a reason to do so. That's how I would use a gap. I don't. I'm just saying how I would use it if I was going to use a gap. Does that make sense, Lee?
Yeah, perfect sense, mate. Thank you very much.
Yeah. So there's just a couple of ways of looking at it, and it really comes down to your trading style. Like, as much as Tom and I use the same basis for how we place trades, we still do things a little bit differently. And yeah, that's not one of mine. I prefer to use the actionable price action as it's actually working, because I like steady markets. I don't like. I'm a little bit older now. I don't like the Yahoo cowboy markets that I'm hoping something will happen. I'd rather a little bit more certainty. So but look, it's not that they don't work. It's just that you have to trade them a little bit differently. And for me, that doesn't really fit into how I like to do it. So that works on that one. But look, like I say, if you're going to trade the big volatile markets, generally speaking, you're going to get really good premiums on your options anyway. They are golden for that sort of market. And there's a whole module on it in the options course, as most of you already know because you've been in it. They're the sorts of markets where you're placing those particular trades. But it's really easy. I do get a couple of questions actually on, the strategy is all really, really good, but people get confused as to which one to apply. Because there's multiple ways that you can trade every particular setup with different sets of strategies on the options. Well, it's very similar to what I just explained. It comes down to price. How much can you possibly make? Now, oil, as an example, $130, really, really big chance it's going to go back to 100 at some point in the near future. If we put a spread there on top of it, say at 135 to 140, and we're getting 1-to-1 on that, that's a pretty good trade, because we're going to get a 1-to-1 on a pretty high probability trade. If the put was worth $25, it's got to travel $25 before you even make money to get it down to 100. That doesn't make sense. It's a 1-to-1 trade, and the thing's got to move $25 just to get there, right? Whereas the spread's going to get there, all it's got to do is just drop 10 cents. So, but in saying that, if the put was only $5 to buy, and the range was still 100, and there's $25 potential upside, that's a 5-to-1 trade. So that's a way better trade. All the same risk, all of them risking the exact same. Say, for instance, $1,000. They're all risking the exact same amount, but they've all got very, very different payoffs. And that's the thing. I can't tell you in the course which one to do, because we don't know what the volatility is going to be. But in a live market like we have here, I can definitely tell you that one is going to be better than the other, and you can work that out yourself. It all comes down to how much it's going to cost, what the potential reward is, and what the market has to do to get that reward. Okay, and it's really simple as that. The good thing is you've got a whole range of tools, and you're going to pick the one that's going to get the job done. And that's the beautiful thing about. That's why I love options so much, because it means that you can actually tailor the right tool. I'll give you an example. I know there's a lot of guys in here. If there are any ladies in here, I'm sorry, but you probably do tools anyway, so it's not going to be the end of the world. When you are looking at doing, let's say, a job, a home handyman job, and you've got a big range of tools. Right, so let's just say if you're like me and you love collecting tools, every time I get, if I've got a present due from the family or kids, or there's a sale on, I go and buy a tool. I love my DeWalt power tools. Don't ask me why. I'm not even that remotely handy, but I just love using them just for creating crap. But if you didn't have those tools, you end up going to a tool that may not get the job done as well, but it will probably get the job done. And that's how options trading is. And I'll give you an example. If you need to cut out a PowerPoint hole for in class, you need to cut out a square, right? There's all sorts of things that you can use. You can use a handsaw, you can use a multi-tool, which is probably the best and most effective tool. You could use a circular saw, you could use a jigsaw. There's about 5 different tools that you can use to cut out that square and make it perfect, right? One of them is going to be easier than the others, and it's going to be better. And that's going to be the multi-tool, in my opinion, because it's the one that you can make really clean lines in. It'll be done in about 10 seconds, right? Bang. It's exactly the same with options. We know that we are comfortable that oil is going to drop from 130. Like, it could go to 140, but we're not going to lose any more than we anticipate, even if it does, right? We're just having an idea that we think it's going to drop from 130. Which option are we going to apply that's going to get us the best result? Are we using the circular saw? Are we using the jigsaw? Are we using the multi-tool? Or are we using the handsaw? It is simply picking the tool that's going to get the job done. That's going to make you, rather than the most efficient way, which is how a tool would be, the one that's going to make us the most amount of profit for the least amount of risk. Now, the risk is we're obviously going to risk the same amount anyway, because we practice only proper risk management around here, so we're only going to risk the right amount anyway. But which one's going to get us the most profit for that risk? Okay, and that's it's as simple. Does that make sense to everyone? Does that make sense?
Totally.
Good. It sounds straightforward, and you probably think, well, far out, Ty, like, you're stating the blatantly obvious, and it's obvious because if you go through those strategies, I've shown you how to use them in the course. Like, they're all very easy to apply, but it's the selection process, and it's very hard for me to explain that on paper how you can do that. And this is why I love doing videos, because especially Q&A, because we can actually break them down and say, bang, this is what we want to do. So, all right, let's get into some of these markets that people want to check out, and we will go through them one by one. All of the popular ones. Aussie behaved itself like a little champ. Did the move all the way up to the 74.20, which is just a glorious thing. Now, this happened while I was asleep, so this is why it pays to have your take profits set, especially at the levels. Some people make the mistake, and I'm not sure if you guys do, but some people do, of making the mistake of not putting a take profit in, because if it moves really quickly, they might actually just leave it on and look for a little bit more when it gets there, and they'll make a decision at the take profit area where they think they're going to take money out. Now, the problem with that is this exact scenario where if you weren't there for that take profit was just so obvious to me, it wasn't funny. I think I drew this up for Kara on Ausbiz last Friday, because this is when I presented, and it was like it was down here, and I'm like, well, this is obviously the very clear target you're going to go for, and this is why. This is very strong resistance. We know this. So if it's going to break past the 200, that is the area that's going to go, and I'm not interested in going any further in the first touch. So if that's my reasoning and where I think it's going to go, the 74.20, there's no point in leaving. I understand the methodology. Like, people say, well, what if it has a really big booming move and it goes to 75 all of a sudden in one candle? And it has happened. I mean, things can happen like that. Make no mistake. But that to me is an unnecessary risk. If I've got a very clear target to go for, I'm going to put my stop loss in, because if it happens while I'm asleep, which quite often these big moves do, we're going to find ourselves in a place where you've missed out on that opportunity, and it's all the way back where you entered. And sometimes in worst case scenarios, it'll actually go out and take the stop. So this is why we always say, and me especially, when you've got a stop loss and take profit set, there's not much more to do. You don't have to be worrying about anything. You don't have to be, concerned that you're going to be asleep through the trade or this, that, and the other. When you're risking the right amounts and you've got your entry and exit points down pat and actually in, I don't like the mental stop loss, and I don't like the mental stop loss at all, and I don't like the mental take profit probably equally as much. And by that I mean people who say, well, I'm going to take it out if it gets to X, or I'm going to take it out if it reaches Y. That is a problem for me, because that's not really, that's allowing yourself to be a victim or fall victim to the market movements that are going to play with your head. You're inviting a psychology play there that's not going to be favorable for you. Okay, you need to accept responsibility and assume responsibility for the levels. If you're placing a trade, you need to be very comfortable why you're putting a stop loss in place, why you're putting a take profit in place. You need to be very comfortable with those, and you need to stick to them. The mental method doesn't work for me. It certainly wouldn't work for me in the standpoint that, I wouldn't do it. I simply wouldn't do it. And the reason I know this, and the reason I'm an expert on this, is because that's what we used to do. Right, so I know that it doesn't work. It's not because, aside from the, thousands of people that we talk to all the time that make these mistakes all the time, we've made these exact mistakes. Okay, we've tried everything, and early on that was always the go-to. Let's just see, because maybe we can get more out of it. Maybe we can do this or maybe we can do that, and it's disastrous. It doesn't work, and it causes you to make mistakes, because then you start revenge trading and doing all of the crap. So in order to practice good psychology and good risk management when it comes to trading, the main focus should be not to put yourself in positions where it's even a question. Okay, so you don't want to put yourself in a place where you have to make a choice, if you like. That way it reduces your risk of making a bad choice by a lot. Okay, does that make sense? Does everyone know what I'm talking about there, where if you don't put yourself in that position in the first place, you're far less likely to make a mistake? Again, I know it sounds simple, but it's amazing how it can mess with your head, because at the same time, and then what happens here, if I did this right, if I say I didn't put my take profit there, and I wake up in the morning and I see that it hit my take profit, but it didn't have a take profit because it was only a mental one. Nice one, Ty. It's all the way back here. Let's imagine that it didn't actually hit my stop loss and it survived, which it would have in this particular instance. But let's just say that it did this. When it hits the 20 moving average again, I'm going to be almost inclined to take this again and say, well, you know what, I missed it the first time. I'm going to actually reload. I wouldn't, but this is what people do. They all get in, or even worse, if it does hit your stop loss, you think, oh, I'm an idiot for not putting that stop loss there, that take profit there, and actually making money. That's a trade that the market owes me, and I'm going to go again. And all of a sudden you're in again in the exact same trade, but you're already one trade behind because you actually should have already been out. Let me tell you, from a point of experience and absolute fact, the market never owes you anything. and if you think that it does, I hear this all the time. When I'm coaching someone, they say, well, is it, they feel that the market owed them that because they should have got it in the first place. Yeah, and that's not the way the market works. The market could not care less. The market doesn't even know, for that matter. If you miss an opportunity, that opportunity is gone. Do not try and regain that opportunity unless there's an absolute technical reason to do so. It's so important. It's one of the things that it brings many a trader undone, and experienced traders at that. So, point of the lesson: always put your take profit in physically, and always put your stop loss in physically, especially the stop loss. God save us. I mean, the stop loss is the most important thing. When I hear people say they're putting a mental stop loss in, that just does my head in, because I don't even know how they sleep. Because really a mental stop loss is not a stop loss, right? If something happens, if you put a stop loss on oil, if you thought oil was going to 150 and you put a stop loss on oil at 125 and went to bed last night, guess what? You're down about $20 more than you should have been, and that could be 20% of your account. That's just ridiculous, right? Everyone knows how ridiculous that is, yeah? Mental stop loss, God's sake. It's just the number one rule. Mental take profit is nowhere near as bad as a stop loss, because a mental take profit is an opportunity loss, not a and it can be a physical loss too if it hits your stop loss. Don't worry, especially if it was going to take it, but nowhere near as bad as a mental stop loss. A mental stop loss just doesn't work. It shouldn't even be. If I had a platform that we designed and we owned, I would put fail safes in place that would annoy the hell out of everyone, because I would put things in place where actually the trade, how sometimes you have an invalid input where, if your stop loss is too far or too close to the current price, it won't accept it. A lot of platforms do it, just simply doesn't accept the trade. I would have a code in place where it won't accept the trade unless you've actually got a fixed stop loss and a fixed take profit in place. And once that's in, you can't make them any bigger. How about that? And how annoying would that be for everybody? I probably wouldn't have any traders. It'd only be it'd be a platform just for me because no one would want to use it. But you know what? It would actually stop people from losing money, and it would make people trade the right way. So go figure. You know, and the irony would be, the absolute irony would be that would actually annoy people.
Because maybe doing the right thing, a good idea.
It would be. I think it would be a great idea, but it would annoy people, Warwick. And people won't use it because it'll be like, well, you know, I'm being restricted. I could have made more.
It would annoy the hell out of me, but I would use it. I can guarantee you.
I would use it too, and it wouldn't affect me because that's what I do. I absolutely always have those in place, so it wouldn't affect me at all. I would just do it. Double says, don't hold back, mate. Once I get passionate about something, I get very, very passionate about risk management and psychology, and I very, very rarely hold back. And it's only because, and the only reason I do that is because I know how dangerous that is. Okay, and because I've seen it happen live, I've seen it happen in our accounts early on, but probably just as importantly, I've seen so many, potentially good traders come unstuck because of it. And one really bad experience can completely decimate, a year's worth of good work. And a lot of people just don't come back from that. And that's why I'm passionate about it. I'm just hoping that sometimes the passion will, drill it home to the point where.
Hey, Ty, just one on the psychology, a question around that. When you set your take profit and sometimes you put the technical set you up, you set your take profit, but for whatever reason, you miss it by, sometimes a few points of a pip, right? Just doesn't hit it and then reverse. How do you sort of deal with that? You're just like, oh well, and then, just set up to the next one? Or because it does happen that you've just set it a little bit too far, or it misses it just quite narrowly. So
yeah, it happens. It does. It certainly happens, and it certainly happens to me as well. What I normally do is if I woke up in the morning, I'll give you an example. It's probably the best way to show you. If I had my take profit set at, well, that's not a good line. I've got too many lines there. Let me just put. Let's just say that was my take profit, okay? And I woke up in the morning, and it really is because I never put a take profit above a resistance zone. If that was my take profit was actually right on the green line, but even then that was slightly below. But that's okay. But let's just say, for your example, if that was my take profit and I woke up in the morning and the market is down here and my entry point is the break of these zones where it was, what I would do is I would, at the very, very least, I'd reassess. If my stop loss is still alive, I would probably, if I still believe in the trade, okay, and my stop loss is below the 20 moving average, I would actually leave it in. But what I would do is definitely bring that stop loss, the take profit down below that level, because I wouldn't expect, if it missed it the first time, it's probably going to miss it the second time. So I'd be more conservative on the second approach. If the trade still made sense and it was resting on a 20 moving average, and I would say, you know what, if I came today and had a look at this, and if I ignore the previous trade, like let's just say that was yesterday, for instance, just as an example, and I woke up today and I didn't see that yesterday, but I'm looking at it thinking to myself, there's probably a really good chance of bouncing off a support zone. And now that it's set a new high, it should have pretty plain sailing to actually get there. I would treat that as a completely new trade, even though it's an old trade, and say, all right, I'm going to leave that in. But if it did, it's a really good question. I'm going to do something to show you exactly what I'm talking about. Let me find my Epic pen. Got so many things on my chart at the moment that, hang on. One thing that really annoys me about Thomas is he makes the Epic pen look so damn easy, but it's actually not. It's annoying because he's one of those Gen Y bloody freak shows that seems to be able to navigate a desktop really, really quickly and easily with about 20 things on it. All right, here we go. If it did this rather than this, and then tried again, and then came down here, and that's what it was like when I woke up in the morning, I would actually take that trade out, whether it's actually at a loss, whether it's actually breaking even or whatever, because all of a sudden, this is a different trade. Okay, it attempted it, it came down, it attempted to go again, but failed again at a lower high. Okay, this particular one hasn't failed again at a lower high at this point, but if it did this, I would take it out. So they're the two scenarios. Okay, so if it missed me and it did this, that's still a valid trade because I think it's still got the potential to get there. But if it looked like this, I would take it out if it hasn't already taken it, my break even. And I wouldn't be hoping that it's going to go. I don't hope for anything except, maybe Taslotto occasionally if I get a gift voucher with a Taslotto ticket in it, because I don't actually ever buy it. But if I get a voucher, that's the only time I find myself hoping, because if you're hoping in the market, generally, you're going to come unstuck. I have a bit more faith in my setups. So I wouldn't be, if I see this, I wouldn't be hoping on maybe it's got a fighter's chance, my stop loss is still there. I would just take it out and look for the next trade, because the problem with leaving it on, if it doesn't look good anymore, if I wasn't going to wake up in the morning and place it because it looks like that, I certainly wouldn't have had a lower high, lower low sequence, right? Is I'm going to be sitting there hoping for this trade, and that's going to distract me from finding the next one. Okay, and that's the danger, that you get caught up waiting for something that's not even that great anymore, and it's stopping you from looking at the next good trade, and that's not only is it going to cost you potentially this trade, but it might cost you another one or two by focusing on something that you're actually hoping for, and that's a no-no. All right, so does that make sense?
Perfect sense. Thanks, Ty.
Yeah, it's just. Yeah, that's just the way I look at it. Look, I'm not saying that I'm the only one that's right. Like, people have their own method, but to me, that's how I trade it. And the fact that you guys are here for my Q&A means that you're interested in my input. So that's why I'm so strong on what I say. I only say what I do. I don't, I don't talk about stuff that I don't do, because to me that's pointless. If I don't understand that, what the hell would I talk about it for? And there are times when people do throw questions at me where I've got I've got no idea what they're talking about, and I'll either get back to them, or I'll just say that's not really my area, because it's no point. I'm not going to try and make it look like I know something that I don't. I know all this works, and that's why I can talk about it with confidence. So hopefully that answers your question. But just at the same time though, just so you know, if it was this and it was still looking good and this lightning bolt wasn't there, I would definitely getting that level and bringing it down. Like, I'd be bringing it down to below that level and taking less. I'd be aiming for I wouldn't be going for the all-time high again and saying, well, it's going to make that, that new recent all-time high. I would be looking for less and saying, I probably should have, I was probably a little bit adventurous on the first attempt. I'm not going to be adventurous on the second attempt. All right, so hopefully that makes sense. Let's get through a couple more of these, because I know I've got a couple of requests. I've got a request for the euro. Let's go to the euro now. Let me get rid of that. Okay. So euro, well, I mean, the euro, it was popping yesterday during the webinar. It was absolutely, especially during the webinar one, and you could just see it going. So part 2 and probably part 3, because there were 3 parts to the Tuesday Market Watch trade this week. The first one was the 109.50, which is the first scalp. The second one was the 110, and then there was the 110.50. And it's reached all of them now. So look, I'm not even, this could certainly go to the 20 moving average. It probably will, but in the first instance, if you took all 3 trades on that, if you took all 3, I didn't. I only took the scalp, because when the markets are volatile, I just take the little short and sharps. But there were 3 opportunities in that little video. And for anyone who didn't watch it, you should go back and see it, because it gave us all the clues. But if you took all 3, you effectively got a 5-to-1 out of that trade, because all of them played out, and some of them were bigger than others. So, and you just had the feeling, and it wasn't so much that this was at support. There's no question about that, but it was actually more about the dollar index. This was the problem. And when you go out, and I did talk about this in the webinar, in that video, sorry. When this is a monthly chart, right? Like a seriously strong time frame, the biggest time frame that we really look at. We don't look any bigger than a month, right? So when you see absolute resistance at that point for at least 2 months, and then a big sell-off off it, and then another attempt at breaking it right there, and a huge rejection off it, and then 3 massive attempts in a row massive, and this one was a big breakup too. You're talking about 300 or 400 points above that level, and it pulled back 3 months in a row to actually close at the exact same level that it was trading, right? That does not bode well for what it looks like here, right? It did not bode well at all. And to me, that was a telltale sign. That's why I felt so strongly about the euro, that even in the shorter term, although we've got turmoil galore, you could write a book on all of the things that could make the euro go down at the moment, and the dollar index go up. At the end of the day, technicals are technicals, and the truth is still nobody really knows what's going on. Everyone's just playing the day-by-day, hour-by-hour approach and waiting for news to come out. So like I've always said, and like I'll always continue to say until it proves me wrong, the markets always gravitate to key zones when they are uncertain of the direction. They'll always gravitate to key zones, and they will respect those key zones. And this was no exception. As you can see, that zone is extraordinarily important for what happened basically in 2019, okay, and 2018 for that matter. So that is why I felt very, very strongly that, yeah, we were going to see weakness here. And weakness here is going to equal strength in the euro. Okay, and it's really as easy as that. People always, a question I get a lot from people is, how many correlations do you actually do? To be truthful, not a lot, because to me, I mean, it's not that they don't work; they absolutely do. But I don't really, I can do it very, very quickly, and to me, I can find trades fairly quickly just by looking at a couple of things. And I know the greatest correlation for me, I love the euro and the dollar index, and quite often, this does lead the euro into what it's about to do. You do get that little bit of a clue before it actually happens, because most of the time the dollar index hits a support and resistance zone a little bit earlier than the euro does. So it almost allows you just that little bit of checking time to allow you to set your alerts. So that's why I like the dollar index, and that's why I like that trade. So hopefully that makes sense. To me, it was a pretty simple one. Did anyone trade that, by the way? Anyone get on the Tuesday wrap trade? Great, good job, Raymond. And I've got my Discord, got a couple in Discord saying yes, they did as well, and one just missed it. Okay, cool, good. Well, I'm glad people are watching that video. That's probably a plus. In my mind, of all the things that we do, if I was going to rate our videos in importance, and don't tell Tom this because he may not like it, but in videos of importance, to me, Q&A is one of the most important, because I think this is where we learn stuff, because I'm able to actually concentrate and delve deep into why we do something and why we wouldn't do something. I think the Tuesday Market Watch is a must-see, whether you're a good trader, bad trader, or whatever, because that's actually a trade that I'm going to take, and why I'm taking it. It's the methodology behind it. And I've been doing those Tuesday Market Watches for 2 years. And realistically, if you went back and took every trade in those Tuesday Market Watches, I think you might be surprised at the results. They either get in or they work. It's pretty rare that they fail. That's because I'm setting them up like I would actually trade them, and most of the time I actually do. Okay, so that's why the Tuesday Market Watch is probably that and Q&A. So I'm saying maybe that's just a little bit biased, because I'm saying these two events that I do are probably the most important in my mind, but they are only because we portray a lot of teaching in that. Okay, the third one would be the Wednesday webinar, and the Monday and Friday. Look, the Monday Market Watch that Tom does and the Friday Market Wrap are both similar in the sense that we're sort of just looking at the setups and looking at what we're doing either side of the buy or the sell. But probably the Tuesday, Wednesday, Thursdays, Wednesdays are good because we cover a lot and we talk about the setups as well. But yeah, in my mind, the Tuesday and the Thursdays are really, really important, because you can actually learn something, even if even if it's not a trade setup, you're actually seeing what we do and how we do it. And like I said, I mean, you guys are here for a reason. And at the end of the day, it's not like we're doing it after the fact, like we're doing it as it works, right? So that's the important thing. People need to, learn how to do it in real time. Otherwise, you don't want to be a hindsight trader, otherwise you're going to be not making a hell of a lot of money, right? So good. So that's what. But let's not tell Tom that. Let's not tell Tom that, because he won't. He probably thinks that his videos are the most important must watch of the week. And you know what? For some people they will be, because it really depends on what you're trying to achieve. If you are looking for market analysis and ideas to potentially trade, especially in the US market and cryptos and things like that, absolutely, those videos are the most important thing you need to be watching. Probably his videos that release mid-morning, even more so than the live stream, because the videos are actually more succinct and they delve right into it, where the live stream actually answers questions. But so it really depends on what you're trying to get out of it. We like to think that between us, we cover nearly what everybody wants. And I know people want even more, and we try to do as much as we can. But we try to cover a diverse range, and everything is different. So that is good. So hopefully you're learning plenty. Good. So, and that's why, and Clem says that, and you're right, a lot of people do actually do that. And this is why I love the Tuesday videos, because we set them up, we put them in place, and they'll either get in or they won't. And then we can actually see them play out. But you see exactly how I set them up, because it's amazing how many people actually get it very, very close to setting up right, but they just do, one little thing wrong that can bring the trade undone. And it's a real shame, because most of the time most people's analysis, once they've been in the room for a while, are generally pretty good. It's just the little things that bring them undone. But that really comes down to practice. It's practice, repetition. To me, I don't make anywhere near as many mistakes as I used to, and my mistakes are silly mistakes most of the time. Just being, not paying enough attention, or being a little bit careless on where I've put a stop loss, like I've completely missed a zone or something like that. That's the extent of my mistakes. I very rarely make a mistake of whether I actually should have taken a trade or not. Very, very rarely do I make that mistake. It's just my mistakes are more silly little mistakes where, I probably overestimated or underestimated a TP or a stop loss, something like that. We still make them, but very, very rarely. And when we do, they're generally silly mistakes. I don't make the big fundamental mistakes anymore. I very rarely look at a trade that lost, because a losing trade's not a bad trade. A losing trade is just part of the business. But I very rarely look at a losing trade and say, I really shouldn't have placed that trade. Because to me, losing trades are part of the business. It's a case of as long as I can look at it and say, I would place that trade tomorrow and I'd place it again the next day, I'm comfortable with that. And that's how you all should be. Don't look at a losing trade as a bad trade unless it's a trade that you shouldn't have placed. Hopefully that makes sense. It probably sounds ridiculous and convoluted, but hopefully that will make sense. All right, let's skip through a couple of very quick ones before we wrap her up. ASX 200, look up to the 200 again, a 20 moving average again, very, very basic off support, still very, very volatile. In my mind, we need to be aiming for the key levels and keeping our trades short and sharp. No long-term moves here, all scalping. Okay, that's all we're doing. Selling off the 20, landing on that 69.50. It hit it again. I mean, this has been an absolute bonanza for us. Like we've made so many good trades over the last probably 6 to 7 weeks in some of the bigger accounts of options. It's just been absolutely a masterclass of trading, because they're all, the levels are just there. They're really, really easy, and they are absolutely playing the game. Absolutely playing the game to perfection. So as much as we've had volatility, apart from that first week when the invasion first started, the rest of it has been a pretty well behaved market. Even though it's been volatile, even though we've seen big moves, the technicals and levels have been very, very well behaved, which makes for a very, very good environment to actually trade. So yeah, to me, this is the zone we're interested in until it breaks up above the 71.60 again. Not interested, and when it does that, we'll be aiming for the 73.50. And if it starts to short off the 20 moving average again, 69.50 is well within its sights, but all just short and sharp scalping, and you're not going to have too many problems there. We will go to the Russells, another quick question that I had. This one is finding itself in a zone very, very similar to the ASX 200. You can see a lot cleaner though, obviously, because it's got better trading. You can see here that it's trapped between the 20 moving average now and this very strong support zone, which seems to be holding out. Like Thomas and I have said many times over in the webinar, if this level breaks and it actually happens to get a close below the 1871, look out, because the pullback and the downtrend is going to continue, and it's going to be very, very ugly. very ugly. So let's just hope that doesn't happen. I don't really want that to play out. I think I would be happier if it sort of hovered around this area now and potentially pulled up and pushed past the moving averages at some point. The high target is very easy. This support zone here around the 21.27 is a very, very logical zone. If it closes above the moving averages, that's what I'd be aiming for. If the 20 holds it up, I'd be aiming for a scalp down to this level again, and probably until it eventually breaks, you can probably play that game where until it does break, you can keep longing it. But it is caught in this little mini zone now, and it needs to break out of that 20 zone and the 1960 area before I start to get excited about the 200. All right, so that's how I am looking at that one. So, all right, guys, thank you so much for joining us. We've got a lot of prep to do before the conference, so we'll certainly still be in Discord. Friday rep will be out very, very early tomorrow because I'm flying out to Cairns after that. Next week, yeah, most of the videos will be continued. I'm not sure, depending on internet, whether I'm going to be able to get a Q&A done next week, because the Q&A uses a lot of bandwidth. I can get videos done because I don't need internet for that, but we'll see how we go. I'll let you know certainly once I know how the internet is up there, but the videos will definitely come out. All of the short form videos will come out, and Tom is definitely doing the webinar because he is back on Wednesday. So for all of you who are coming to the conference, I cannot wait to see you on Saturday and Sunday. And as for everybody else, we'll try and bring you as much information as we can from there. And of course, we'll talk to you in Discord as normal. All right, everyone, thanks very much. Talk to you soon.
Thanks, Ty.
No worries, guys. Thank you.